Hello, this is Eric Boyce, President, CEO, and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 26 of 2023. Please see our disclaimer for important information. Well, some of the big news that we got over the last week was the first revision of the fourth quarter GDP number. And so that came in at 2.7% annualized versus the previous and the initial reading of 2.9%. We'll see the derivations of it in just a second, but just note that you can see here that we are in a slowdown. We saw the two negative quarters there in 2022, the first and second quarter, and then we had a bit of a rebound, kind of a dead cat bounce, if you will. And so we had positive performance in the second half of the year, but clearly we're in a downtrend now. We're probably going to witness slower growth in the quarters ahead, and we've got some estimates out there as far as what the market believes GDP is going to look like. And then we've got some other comparative data that I think will be pretty interesting. But just know that now with the second revision, we'll get one more revision of this GDP number before it will be deemed final. We'll get that next month. But third quarter GDP growth was 3.2%. And the newly revised fourth quarter GDP number was 2.7%. Now here's a derivation of some of the changes that were evident in that revision of negative 20 basis points that you see here in the red on the far left. So again, the revision was down from 2.9 to 2.7. And you can see some of the changes. And as the BLS looks at this data and refines the calculations, oftentimes you do get these little subtle revisions. We'll say that in this case, it was a couple of rather interesting and poignant changes that were made. So net exports were revised down a little bit, not a game changer, 10 basis points, not that big of a deal. But if you look over the right, business investment, this would be like inventories, were up rather sharply from the initial estimate. But they were more than offset by a drop in consumer spending. And so this is reflective of slower consumer spending than was previously thought in the fourth quarter, which obviously from an economic growth standpoint is important. We know the consumer is extremely important to the economy. We know the Fed has been working rather diligently to try to manage that consumer spending down as a mechanism to slow growth and then, of course, slow inflation. But, these are pretty important revisions here. So we know the consumer was less robust in the fourth quarter, and we do know the inventories were up a little bit more. And inventories traditionally can be rather volatile in an environment where you have slowing demand and you have rising inventories. You typically are going to see probably negative contributions to growth from inventories in the quarters ahead. And here we have probably another good indicator of slowing demand in the economy to a certain degree. We have final sales to private domestic purchasers. And so this would be like, kind of a core purchasing index, if you will. And so that's basically flat at this point. You can see the downtrend there over the course of the year. So this is essentially what the Fed is trying to engineer, if you will. This would be kind of almost like a core GDP would probably be a better way to put it. But you can see here clearly that trend is down. Here's a survey from Bloomberg for the first quarter GDP consensus forecast. And so the way to read this is, basically several years, a couple of years ahead, people are predicting what's going to happen here in the first quarter. Like right now, they're predicting what's going to happen in the first quarter of 2025. And so these estimates change over time. And so what we're looking at here is the trajectory of those estimates for first quarter growth as they existed even back in 2021. Back then, we were looking for somewhere around 2.75% growth, and then market got a little bit more optimistic as we entered 2022. Again, we know that A lot happened last year with Ukraine, interest rates, inflation, blah, blah, blah. And so those estimates came down quite a bit to the point where last October, in November, they were at their trough of about 0.4%, as you can see. But over the last couple of months, we've had a little bit of optimism in terms of economic growth. Maybe up until the latest round of inflation data, there was more optimism with regard to maybe economy was going to grow a little bit faster this year. And so in the first quarter, as it stands right now, be interested to see how that plays out because we are getting ready to enter the last month of the first calendar quarter. So we'll have to see where the data comes out. But right now, the estimate is for around 1.5% growth for the quarter. Here's the same look at the annual. So this would be a look at the 2023 GDP number as it's evolved over time. Again, going back to perhaps the beginning of 2021, that was thought to be around 2.5%. Market even at that point expected just generally slower growth overall, but then you see, just as we saw in the quarterly estimates, the annual estimate has come down quite a bit. In fact, again, itself also falling to around about 3 to 0.4% by the time we got to the end of the year. And just like the quarterly estimates, a little bit more optimism as of late. Right now, though, looking for fairly anemic growth in 23, somewhere around 0.7%, which clearly stands below long-term trends and very much expected in the marketplace. So there are some things that offset. We know the labor market's very strong. We know incomes have been relatively strong. And when you see those things, you typically you're not in front of a recession. But here we see excess savings. And I'd say that, you get down into the various income tiers, the quintiles, if you will. And so that chart on the bottom is a little bit busier, but you can see over time that those have all trended relatively higher, except for the bottom quintile where incomes are falling. So the way that basically the takeaways from this chart, one, we still have an awful lot of savings, relatively speaking. We have an awful lot of excess savings, relatively speaking. However, all the bottom quintile of income earners are really feeling the pinch, which should be no surprise. Things that they tend to spend more money on, like food and gasoline and things like that, tend to impact their budgets more than it does the upper income quartiles or quintiles. But there's still firepower overall to weather this storm. And so when we look at consumer spending, we look at retail sales, there's still a little bit of staying power, although we do see some changes in spending habits. And we've got a chart on that coming up a little bit later. Here's a chart that shows real disposable income per capita. Now, we talked about income, and we know that that's been stronger on a relative basis. Here's a chart that shows us where, once you factor in inflation, where real disposable personal income is. And this will be disposable income that falls after some of the essential spending items. And you can see the effect of inflation here rather dramatically as this personal income number on a real basis is falling below its trend line. And here we're looking at delinquency rates on various forms of credit. You can see a student loan in the red there over a period of time. And this data series goes back quite a way. So when you look at a trend line basis, student loans, which are now federal loans, are held in abeyance. So those are at near historic lows, but we'll probably see those pick up when students are having to repay those loans and that period of forbearance ends. But you can see in these other categories, mortgages just picking up a little bit, revolving credit picking up a little bit, and you see auto loans and credit cards, which are usually the first things that don't get paid in an economic downturn. And this is data that you always watch when you're heading into a downturn and obviously in a recessionary environment where things are not getting paid, because this ultimately leads to the spread in interest rates on higher yielding instruments. A lot of these loans get securitized and sold in the secondary market. So you see a lot of impact on credit rates, credit spreads, things like that. And you can see clearly here that a lot of these forms of credit have witnessed an uptick in delinquencies. I thought this chart was really interesting because it does show you kind of a share of GDP where all these budget items look on the federal budget. And, we know we've been dealing with a lot of continuing resolutions to fund the government, and it's clear that the discretionary part of the budget is a relatively small part of it. And I've starred some areas that I thought were really important. So the first column here, you have the average of 1973 to 2022. And you can see that we have typically operated in a deficit. So our revenues are 17.4% of GDP and our outlays are 21%. So that means we're in a deficit. Now, 2022, our revenues were a little bit higher as a percent, but our outlays were more. And we know that that's been the case for a number of years now. You've got mandatory outlays that have really spiked and are expected to be relatively high, which is that third column that looks out now 10 years from now to kind of guesstimate where that's going to be. And this is all data coming out of the Congressional Budget Office, a CBO, a nonpartisan organization here. Gives you objective views. So you've got the mandatory total going up, you got defense coming down. Importantly, you have net interest. We've been operating in an environment of very low interest rates, and so that burden on the federal budget is going to increase over time. We've been expecting that. Deficit total, you can see that those numbers are getting worse, and then of course the debt held by the public also increasing dramatically over time to help finance those deficits. Now here we're looking at a chart of the U.S. economy relative to other economies, and so this would be basically a percent of the size of the U.S. economy. Looking in the kind of the yellowish amber line here at the year 2000, and then the blue line represents 2022. And so, as you scan down this list, you can see the obvious ones that have changed. Japan, with its very limited rate of growth, has declined. Its economy relative to the U.S. has actually declined rather dramatically over 20 years. But China, in its emergence and its accession to the WTO, the World Trade Organization, has clearly rebounded. Now the Chinese economy is about 72% of the U.S. economy now, expected sometime, perhaps to take over the U.S., but we know that there are some very, very significant demographic challenges to China. You see Germany, India is actually increased its share as well. But if you look at UK, France, Italy, most of the European countries, they've all witnessed, even though they've witnessed economic growth, but that growth has not kept up the pace of the growth that we've witnessed here in the U.S. Now we'll talk about some inflationary issues here. Here's core personal consumption expenditures, inflation, quarter over quarter, data that we do get on a quarterly basis here. You can see here that number, while in the aggregate is falling, it was above the estimates. And this is very consistent with what we've seen with all the inflation, the latest round of inflation data. It still represents a downtrend, but the downtrend is beginning to temper its decline. And the latest round of inflation data really across the board has been above expectations. And so, the question now is the Fed going to have to react to this a little bit more strongly? But there are a lot of people out there, and I was in that boat too, that felt like, inflation, the declines in inflation may temper somewhat. I think we still have to see what the effect of the Fed rate increases is going to do here, but we do see that the rate of drop is slowed a little bit. And here's an example here where the estimate was expected to come in at 3.9%, but the actual PCE inflation number came in at 4.3 for the fourth quarter. So again, takeaway here, inflation, it continues to slow, but the rate of decrease may begin to slow as well. And just like we saw with the GDP estimates, here's the consensus forecast as it has evolved over time for 2023 consumer price inflation. And the latest reading here is 4%. You can see that that's come up very dramatically during the year last year, and then as we felt like maybe some of this data was looking a little bit better towards the end of the year, then that inflation number went down, and now we see that latest uptick. And again, I think 4% and maybe even slightly higher than that is probably something that we should expect at this point. We'll watch the data, of course, but well, let me rephrase that. Likely that we'll see higher than trendline inflation for some time. We see egg prices here moving up dramatically on a price per dozen. I mean, you can see relative to the beginning of 2021, we're basically 4 times the cost. And here we have grain prices, and this is indexed from the beginning of 2022. It shows you the impact of the Russian invasion of Ukraine, which, as we know, was very disruptive to global grain prices, which we also know grains are shipped globally. It's a global commodity, so there's very visceral kind of price reactions when you have a disruption of that magnitude, i.e. the invasion. So those prices came down as we got to the summer, and you could see that they're moving back up again. So as we talk about food price inflation, you just saw in the last slide, we've got eggs, and these are things that you see the inflation impact when you go to the store. When you talk about soybeans, corn, and wheat, it's a little more nuanced because these are inputs into cereals and things like that, and pastas and things like that. And you can see that those are moving up. So these input costs, while they're below where they were at the peak of the post-invasion time frame, they're still above where they were at the beginning of the year last year, and with the exception of wheat. And so I think this is going to make food prices perhaps a little bit sticky, even though they are coming down. Now, as we look at gasoline, you can see a similar impact. Anytime you have a global disturbance that is likely to impact the transportation of energy, of fuels, et cetera, that you're going to have a price spike. You can see that happened. We had on distillates, so you take oil, you crack it into the various components, kerosene, gasoline, et cetera. See the gasoline prices here spiked in the U.S. to $5 a gallon. They have come down, but they're still above the levels that they were that we enjoyed for many, many years prior to the pandemic. Now, on the flip side, you've got natural gas futures that are dropping like a rock, and they're at levels now that we haven't seen, since the pandemic. So that basically we've unwound, if you will, most of the price gains that we've seen in gas for the last couple of years. Now we'll talk about the housing sector for a little bit. Existing home sales that we see are down for 12 straight months now. In January, they were down 0.7%, which on a seasonally adjusted annual rate, which at 4 million units here is the lowest that we've seen since October of 2010. So a long time. In January itself, just on a year-over-year basis, was down 36%. So we see a dramatic kind of reshaping of the housing environment, and some people say it's renormalizing. You see inventories moving higher, but obviously existing home sales are dropping. And I think with higher mortgage rates, which we'll see here in a second, that it is kind of putting a lid on activity right now. Here's the mortgage purchase index, and this index is as low as we've seen it in 23 years, and it's retouching those lows after the global financial crisis. So, clearly, as we just saw in the last price, activity is just slowing down. We see inventories beginning to pick up. We see mobility slowing down. We see listings stay on the market for longer than we have been used to over the last 18 months or so. And clearly, activity is being influenced by interest rates. Here's our 30-year conforming fixed rate. We saw the peak of over 7% in October, which was a very tumultuous market in the economy, a lot of negative economic indicators before they kind of turned positive again over the last few months. But with this latest round of inflation data showing that inflation, while it's still going down, as we just discussed, is kind of slowing its rate of descent. And so that's actually putting upward pressure on treasury rates, which in turn is putting upward pressure on mortgage rates. And we see here that number is moving back up to around 6.64 here percent in the latest reading. Well, as we look at home sales, we need to look at rents. So we know that rents tend to follow home sales by about 9 to 11 months, thereabouts. And this is great work by BCA, which shows the shelter component of CPI, and which we know tends to work a little bit at a lag. And we know that when you have tenants that are in a unit and you've got home values that are going up, so landlords are having to pay higher levels of property tax. They're passing that on to their tenants in the form of higher rents. But when those values roll over, then there's a lag period between when those lower the impact of those lower values on property taxes is then passed back along to the tenant. And so here is an indicator that seems to suggest that rents are going to roll back over. And you've got a model here by BCA, which based in Montreal, does some great work on this subject. Seems to indicate that. So that would be very consistent with what we're seeing in sales and values moving down in most major markets. So you'd expect rents to follow at some point as well. We've got some data here on the labor market. Left-hand chart shows you that the demand for labor still exceeds supply. That's usually something that narrows when you get into a recessionary environment. But right now we're in an odd space because the quit rates, as you see on the right-hand side, in that blue line, have rolled over a little bit. So we're not seeing as much labor mobility. And so even though the left-hand side would tend to suggest that you're going to have consistently higher wage pressure because demand, of course, is bigger than the supply, and that it tends to be more inflationary with wages. You have this offset with the quits rate rolling over, and so from Alpine Macro here, it would tend to suggest that with the JOLTS quit rate rolling over, that you'd expect to see wages, or at least wage growth, slow a little bit from here. So what we're looking at here is some alternative views on job openings, and you've got the all-in JOLTS number in the blue line on the left-hand side of this graph, which I'll probably focus on more in my commentary here. And you see that is kind of all of these indicators, alternative or the all-in JOLTS number, are peaked at the beginning of last year, and so we've seen consistent declines throughout the year. Now the JOLTS number itself has upticked, so job openings seem by this measure to have upticked. But if you look at Indeed and some of these other hiring portals, it paints a slightly different picture. Now the trend line is clearly down, so job openings going down. This is what the Fed wants to see. They want to see labor begin to kind of like slow a little bit. And so that's clearly an evidence here. However, if you do an average of some of these alternative indicators, that are more like truly market-based, private company data, like Indeed, you get a clear sense here that the job openings are continuing to roll over rather consistently. Here's an indicator that I thought was really interesting as it relates to labor. We know that during the pandemic, that there are a lot of older workers that had quote unquote retired from the workforce. They'd just gotten out. The problem is in our labor data, and we just showed you that slide where demand for labor is still above the supply of labor. A lot of that conundrum is being driven by the fact that we have people that have quote unquote retired from the workforce that haven't come back and not likely to. And so even though we've kind of recovered in a sense from the pandemic, here's a indicator of unretirement, and it's a share of these retired workers that are coming back to work. And so that number is rolling over. And so as we saw the pandemic and the disruption, obviously a lot of those people did come back, but not at the rate that you'd expect. In fact, it's rolling back over again. And so when you think about wages and all of the inputs, we talked about job openings going down. We talked about the mobility of labor, the quits rate kind of rolling over a little bit. And you have all these different factors at play, but one thing that looks like it's going to continue to be an issue to monitor is the fact that you've got these older workers that are just simply not coming back into the workforce. Here's a share of the civilian age population in that over 55 age cohort. This kind of says the same thing that I just talked about, but in a different way. And you see in that green line, you can see the share of older workers in the workforce actually increasing over time. We know that, to sustain, their spending habits and whatnot, that these folks are tending to work longer because we know the average age or the average lifespan is increasing. So people feel more, had been feeling better able to stay in the workforce and work for a longer period of time. So that's why that green line was up in terms of the employed number. And the pandemic obviously disrupted all of that. And you see the employed figure definitely improving, but it's below that trend line. And this is what we're talking about. The labor force participation rate has dropped, particularly amongst this older age cohort. And you see people in that blue line that represents the labor force, and the green line represents those in the labor force who are actually employed. You can see both those numbers are below their trend line, and and not likely to kind of like spike higher anytime soon. Here's debit and credit card spending. This is data from Earnest Research, and what it tells you is that people are changing their spending habits. I kind of foreshadowed this with one of our first slides, and you see big box retailers holding the line, getting a little bit more share. You see home improvement stores just as an example of quote discretionary spending. What people are doing here is obviously their food bill. We just saw eggs up 4 times. 4x here, and people are spending more at the Walmarts, in groceries, and certainly in grocery stores, Target grocery, et cetera. They're spending more on that stuff and less on the discretionary items. Well, let's kind of switch here to the markets a little bit, and so we see here we got S&P 500 net profit margin. We see that number is now 11.3%. You can see the consistent decline through essentially most of the last 18 to 24 months. And, this is something that we're going to have to watch. We know that from the latest round of quarterly reports that managers and CEOs are foreshadowing continuing profit margin challenges, even though we've seen inflation abate a little bit. We've seen producer prices, although elevated still, are coming off of their peaks. But it's going to be an ongoing issue, and profitability and the ability to pass these costs along to the end consumer is going to be challenged because, as we know, real incomes are beginning to are slowing. So, this profit margin issue, the trend may continue for some time. Here's a composite PMI, Purchasing Managers Index, and again, with as we've often talked, when you get some bad data or data that seems to corroborate a slowing, then you get some of these other data points, PMI data here that in the last reading has actually picked up in some areas, and so we see that in these 4 areas that you see on this slide, that the latest readings were above maybe the prior 2 or 3 quarter trend. Here's a quick look at financial conditions, beginning to get a little bit tighter again. We saw that number peak in October. Again, a bad month for economic data, a bad month in the stock market, a bad month just overall for the economy. But then financial conditions seem to ease up a little bit. Again, this optimism that maybe the Fed is closer to the peak in the interest rate cycle, and some of this optimism building into the market, which seems to over the last few weeks have kind of unwound a little bit. And we see financial conditions beginning to get a little bit more difficult, but not quite reaching those prior peaks yet. Here's a money supply. We've talked about this a lot, and the money supply on a 3-month rolling change percentage basis, it continues to be negative, and more so negative. And this is the most powerful indicator of slowing inflation that I can show you. And this will manifest itself in the data over time. This is what's going to slow spending. It's going to slow consumption. It's going to slow price growth, and in turn will slow inflation. And we know the Fed's taking a lot of liquidity out of the market, and this is the purest indicator of what's going on there. Here's a chart of the S&P 500. You've got your 50-day moving average there in the purple line. We are back. You can see coming into February, we kind of reached an interim peak coming out of the end of 2022. And that rally that lasted basically through January, and now we've kind of gone backwards a little bit, and we're retesting that interim support level, and we'll see if we break through it again. As you look back, and the end of last year, we did punch through it in November, and then we punched back below it in December, but we didn't stay there. So I wouldn't get too worked up over this. I wanted to show this chart for a couple reasons. One, to kind of highlight, this little bit of a sell-off here in the wake of what turned out to be a pretty decent month of January. But as we look at the momentum indicators beginning to slow just a little bit here. Here's a measure of the 10-year TIPS yield. You see that in the blue purplish line there, and we're at roughly 1.5% on the TIPS yield now, and so that's overlaid in the black with the S&P 500 forward price to earnings ratio. And you see the relationship here is reasonably strong, and certainly from a directional standpoint, even though the correlation has deviated from time to time. And right now, we are at a deviation point. And so do feel like by this indicator, the S&P 500 is maybe a little bit overvalued. And again, ripe for a continued sell-off in this environment to kind of get us back to an equilibrium point. And I think this is very consistent with kind of what I expected last year, and it talked about maybe the first half of this year being a little tumultuous. You get these little rallies, then you get these sell-offs, and you get another rally, and so on and so forth, until there's increased kind of visibility on when that termination point is on the rate cycle, and when maybe the more pronounced slowdown is going to happen, and then accordingly when that next market upcycle is going to begin to manifest itself. Here we see hedge fund data. This is an increase in hedge fund investment in equities. So to some degree, we've seen some interest here over the last, really over the last month in equities. So kind of used this sometimes as a contrarian indicator. And we're seeing a little softness in the market, but yet hedge funds are continuing to buy stocks. And looking finally here at the relative value of domestic value stocks versus international. And so what I'd say here is consistent with what I've said over the last few months, just observing that international valuations are extremely low relative to U.S. valuations. And we have been taking steps to kind of begin to increase that exposure. Because of this reason, you have a major value differential, which by this chart going back to really the beginning of the century almost, tends to revert. And so you tend to have equilibrium. Now the question is, are you going to do that by rising international values or by falling domestic valuations? And I think you have maybe a little bit of both, but clearly international is relatively cheap to the American counterparts. That's all we have this week. Hope you've enjoyed the chart pack. Please feel free to reach out if you have any questions, and look forward to seeing you again soon. Take care. Bye-bye.